Hello, hi, I'm Nick Burgess, and today I'm going to talk to you about real-time models and risk using the Jacobian approach. Now, the Jacobian approach is an advanced approach, and what it does is we can use it to accelerate any model, and we can use it to accelerate risk, so that we're able to compete in fast-moving electronic markets. So we're able to have our models that might be traditionally quite slow to run, um, and also to have a risk, which sometimes is very slow to run. And we can take those models, we can take that risk when we can accelerate it and make it and turn them into real-time models that are suitable for electronic markets. It's an advanced technique. I'd love to take you through it. So what the plan is, I'm going to take you through some slides that I've prepared in the last day, and I'll show you everything and all the formulas, all the background materials. They'll be in the links within the slides, and they'll also be below in this YouTube video. So let's go. I'm going to share the screen. Give me 1 second, and I'll take you through those presentation slides. 1 second. Great. So here we are. So here are the slides I'd like to sort of take you through real-time models and risk using the Jacobian approach. So the format of the slides are as follows. So part one, I'm going to take you through the theory of real-time models and risk. I'll give you an introduction to the theory. We'll talk about the calibration process in general. We'll discuss the Jacobian and the choice of state variable, and then I'll give you a quick example of real-time models and risk using interest rate models as a quick sort of case study. Then in part two, for the pricing and practice, we'll dive a lot deeper into a case study using the credit market as an example. I'll take you through what a credit default swap is. We'll talk about real-time credit models, and we'll talk about real-time bucketed credit risk. How do we get so I'm just going to show you how to make our models super fast, and I'm going to show you how to make the risk real-time. Now, all of the information that we're going to sort of encounter here, all the formulas, um, they're going to be sort of covered in my research papers here, where the link is sort of here, and also I have a book which covers the material quite extensively, and the link is here, also here. Anything that we look at here in terms of background materials and formally, they'll be in the links below this YouTube video. So we'll continue from here. Please subscribe to my YouTube channel, and let's jump in. So excellent. So part one, the theory, real-time models and risk. So firstly, I'll give you an introduction into quant models. So what we see here is a Bloomberg screenshot of the interest rate curve on the ICVS page in Bloomberg. And this is a US dollar SOFR curve, which is built in interest rate markets. And so, given a selection of liquid market instruments and their prices, we're able then to reverse engineer things and and apply the market data used for those products and the market data on all dates. So the solving process is called calibration, and the market data output is usually called a curve. So what we're doing is we're looking at the market at swaps that are liquid, and by liquid I mean these are swap transactions that are actively trading. We're not interested in taking market data that's stale, where there's nobody trading the instrument. So we want to select liquid instruments, and what we're going to do, given those prices and those instruments, we're going to sort of reverse engineer things and solve for the market data that was used to produce those market data, to produce those prices. So here's an example swap curve. It's taken from Bloomberg. And so given these orange swap instruments and their prices, which are quoted in par rates, we're able to solve for forward rates and discount factors. Bloomberg are here showing the zero rates, but we're interested in forwards and discount factor. Zero rates is not really what we're after, but this is just for information. So we use to get the information that we need, the forward rates and the discount factors, the market data used to price these instruments. We use solver algorithms, and that will imply the market data on instrument dates. So a typical solver algorithm might be something like the Newton-Raphson technique. And then we use the interpolation methods to fill in all the gaps using perhaps linear or spline interpolation. So you can see here on the chart, we use the solver algorithm will give you the market data on instrument dates, and the interpolation then will fill the gaps. Okay, so quant model examples. So in the interest rate markets, given a set of interest rate swaps and their prices or par rates, we can imply the forward rate and discount factors needed to price that instrument. And the output is a forward curve and or a discount curve. In bond markets, we take a selection of bonds and their prices that we can sort of visibly sort of see in the markets, and we imply bond yields and create a bond yield curve. Similarly, in credit markets, we take a set of credit default swaps and their prices, which are quoted as par spreads, and we can deduce the credit or hazard rate, or the hazard curve. And these hazard rates are used to determine the probability of default for any given date or date range. So here we have three different types of models: an interest rate model where we're taking prices and we're working out what are the interest rate forward rates, what are the interest rate discount factors. Bond markets, we take bond prices and we work out bond yields. Credit markets, we take credit default swaps and we work and their prices, and we work out the hazard rates or the instantaneous probability of default. So here's some three examples. Now, calibration on the solving process. So using a solve algorithm, we can iteratively solve for the market data. This is called calibration. Now, we like to use gradient descent algorithms because they capture the Jacobian matrix as part of the calibration process. Now, this Jacobian J, it measures the change in the instrument prices for a change in market data, and that's really useful for risk calculations. Now, for risk calculations, we don't use the Jacobian directly; we use the inverse Jacobian, which I denote here J minus one. Now, this tells us how market data changes will impact instrument prices. And down below, we sort of see the Newton-Raphson formula, and you can see the inverse Jacobian is part of that formula. Now, we'll go through some of the building blocks to the calibration process, and a lot of this will become a lot more clear as we go through those building blocks, so do bear with me. Now, the Newton-Raphson technique that we sort of mentioned is a very common technique that we use for solving and calibrating yield curves. And the way it works is that we give the model an initial guess, x0, and we iteratively search for the market data that reprices those calibration instruments. The Jacobian J, that captures the gradient and directs the market data, the iteration towards the solution. So for every iteration, we're guaranteed to be moving closer to the solution because of this, because we follow the Jacobian. We have a target function, which is f of x, and this captures the difference between the model prices with the market data, xn, and the actual market prices. So the target function is measuring the difference between the prices that we're getting from our model for each iteration and the actual market prices. And we want that as we go through each of the different iterations, we want that target function, that difference between the model price and the market price, we want that to go to zero. So we're going to solve for the market data that makes this target function zero, i.e. the model prices are matching the market prices. And the model prices only match the market prices because the underlying forward rates and discount factors, for example, for an interest rate curve, or the underlying market data is the right data to produce to reproduce the market prices. Now here at the bottom, we can sort of see this is how we might so normally see the Newton-Raphson formula quoted, and you can sort of see the x's would be the market data, f of x is the target function, which is the difference between our model and the market price, and f prime is the derivative, which is our Jacobian. Now, equivalently, quite often when you're thinking about the Jacobian itself, we just write out Newton-Raphson in a very similar format, but instead of having f prime represent a derivative, we just use j. It's just another an equivalent sort of representation of the same thing. So I tend to use this j representation. Now, here is an interest rate curve example. You can find the resources here on this web link. It gives you an overview of yield curve calibration and using the Jacobian approach. And that's a very, very fast, very efficient way to sort of calibrate and solve for yield curves and their forward rates and discount factors. You can sort of see an Excel example here using for a US dollar LIBOR curve. And what I also have is an example using SOFR curves. And the reason why I'm showing you here the LIBOR sort of version of it is because we still have LIBOR rates being used in the markets, in some markets, particularly in markets like in Asia and also in Scandinavia. So, for example, there's still LIBOR curves being used in Sweden, Norway, and Denmark, and also in Asia. So we need to know how to calibrate For interest rates, we still need to know how to calibrate using LIBOR curves, as well as using the more recent sort of risk-free curves like US dollar SOFR and Esther and Sonia and the like. So I'll just quickly show you what the example looks like for SOFR. It's exactly the same thing, but here you see I'm solving for SOFR rates, and you put in an initial guess using the Newton-Raphson technique. Say we want to sort of guess it's 2%. And then we press the run solver mechanism. Now it's really fast, so it calibrates really quickly. So I'll have to just put some. If I show you the iterations, you can sort of. It just means it'll show you each of the incremental steps. So you see me step 1, 2, 3, 4, and it's already found the answer. And so it's discovered all the forward rates. It's discovered the discount factors. Once I have those, I can price swaps. So here, look, here's maybe a 2-year swap, say. There you go. You can see I'm sort of using these forward rates. My trade matches the market price exactly. There's zero error at all. Similarly, for the 5-year swap, you can sort of see I'm repricing exactly. You can see my risk calculations here are in real time. It's kind of hard to show because it's so fast. I'm pressing refresh, and it looks like nothing's happening, but it's just real time, and that's the goal. And I can also refresh my curves in real time too. It's all super fast. Now this workbook and all the formulae and all the background information, they're in the links below this in the YouTube video. So I'll just return back to the slides. So I'm showing you here the LIBOR version, and here's the link. And then in the links below the video, I'm also showing you the SOFR version as well. So I'm showing you LIBORs and risk-free rates because both are used in interest rate markets. So that was one example. Now I'm going to talk to you about a little bit about this Jacobian. This is the mechanism, the tool that I'm using to accelerate my models and also calculate real-time portfolio risk. And that's not just the total risk. I'm actually going to be giving you all the risk buckets and all the hedges as well in real time. So let's talk about that. So what exactly is the Jacobian? It's a matrix that captures the first order derivative from the calibration target function. It measures the change in price for a change in market data. So it's telling us how our price is going to move with the market. That's our risk. Now that's very useful for standard calculations like PV01 in interest rates, DV01 in interest rates, CS01 credit spread risk in credit markets. It can be used for yield 01. So our risk can be used that way. We can also run scenarios. You say, what if we have a big move in the market? What if the market just crashes? What will happen to my trade price? How much money will I make? How much money will I lose if there's an up move or a down move? So you can run scenarios, so we can run standard risk calculations. Now, this Jacobian is the slope of the target function, and it's used by the model to find the market data solution. So the Jacobian, it's telling our iterations how to update in such a way that our market data moves towards convergence, so that it finds the right market data to reprice our instruments. And the inverse Jacobian tells us how prices change with market data, and we use that for risk calculations. Here's an example of a Jacobian. This is the inverse Jacobian, and they typically look like a diagonal matrix. The Jacobian itself will look like a lower diagonal matrix, and the inverse Jacobian will just typically have values around the center, and above and below would be sparse with zero values. And it's sort of given us the change in price for change in market data, and it's a matrix, an n by n matrix, where n is the number of calibration instruments. Okay, so that's the Jacobian. Now, why is the Jacobian useful? Now, firstly, model calibration. Sometimes it's fast if it's very well implemented in a good library, and sometimes it's complex. Sometimes it's implemented in a complex way. Sometimes perhaps we're doing it in Excel. But calibration, quite often, if it's done well, calibration isn't necessarily that slow. So if you do it in a professional C++ library, it shouldn't be that slow. Although even then, there may be problems, there may be reasons why calibration might be slow. And using the Jacobian approach, we can take these slow calibrated curves and we can make them fast. So what do I mean by that? Specifically, what do we mean? We can run a slow calibration. We can run our calibration once. we can perform a full calibration, and perhaps that's slow. Perhaps that takes 30 seconds. Perhaps that takes a minute. Um, and then instead of and then once we calibrated once, that calibration might be slow, but the second time, next time we need, when the market data changes and we need to perform an update, instead of doing a full calibration, we can just refresh the original curve. We can actually update the original curve without performing a full calibration, and we can use the Jacobian for that. And the formula for it's right here. We take the original curve, and then we use the Jacobian, and we multiply the inverse Jacobian, and we multiply that by the change in market data. Now, the Jacobian's telling us how will our curve change for a change in market data. So it's actually it knows how to update. So if we take the inverse Jacobian, multiply it by the change in market data, that tells us how the curve has changed, and we just add that difference back onto the original curve to create a new curve. So instead of doing a full calibration, we can do this update. We can just update the original curve using our Jacobian, using the inverse Jacobian. So that's one really useful approach. Now, another thing we can do is it can be used to calculate real-time bucketed analytical risk. And so we can create this risk matrix. So by taking a trade Jacobian, multiplying it by a curve Jacobian, which is the one that we're talking about here, and then multiplying it by a shift size of 1 basis point. Now that's the standard shift size for risk calculations, but if you want to run a risk scenario, you can change those shift sizes to be something else. Now, the trade Jacobian we're going to talk about shortly. The curve Jacobian is the one that's coming from the Newton-Raphson approach. And I'm going to show you some examples of all of this shortly. So, but basically, for the real-time risk, it really amounts to taking a trade Jacobian, which is a vector, multiplying that by a matrix, and then that n by n matrix, where n is the number of calibration instruments, and then scaling that by 1 basis point, which is this shift size of 0.01%. So that's the formula here, and I'll give you some examples shortly. Now, we need to talk a little bit about the choice of state variable. The state variable is the market data we're solving for. And additionally, please note that when we're calibrating prices, we can use the instrument PV, which is the dollar value of our instruments, or if we're looking at things like interest rate swaps or CDSs. Interest rate swaps don't typically quote as PVs. They quote as the standard instruments, interest rate instruments. They quote as par rates, and standard CDSs they quote as par spreads. So you can so prices can be dollar prices, or they can be these par rates and par spreads in percent. Now, we must select the risk factor as the price variable if you want to use the Jacobian for risk calculations. Now, what does that mean? It means don't use dollar values, don't use PVs, don't calibrate to a 0 PV, to the instrument PV. If you want to use your Jacobian for risk calculations, you must calibrate to the par rate or the par spread. So the par rate for interest rate swaps, the par spread for CDSs. So use the risk factor, not the dollar value of the instrument as the state variable. So for interest rate and credit risk, don't select the PV as the price variable. Instead, use the par rate or par spread. And we'll have an example of that shortly, explaining why. Now, here's an example of an interest rate curve for a real-time fast rebuild. Now, I'm using L here for LIBOR rates, but this also applies to SOFR rates and risk-free rates. They all have the same approach, but I'm using the L notation because we still have LIBOR curves as well as SOFR rate. We still have LIBOR curves as well as the risk-free curves. So it's something we all need to be aware of. So I'm using the L notation here, but it's the same for risk-free rates. These are forward rates. So if we want to know what our new forward rates are going to be in an interest rate curve, we follow this approach. We take the original forwards, which you see here. So you calibrate once using a full rebuild, which may be fast, which may be slow, but and then we take the inverse Jacobian and we multiply that by the change in market data. These two things together, the inverse Jacobian and the market data, that tells you how the forward curve has changed, and you just add that change onto the original forwards to get your new forwards. And so the way we implement this is that we will do a full rebuild, which ticks away in the background. Now, for me, my full rebuild, which is my slow curve, runs at a very modest sort of 10 milliseconds, sometimes it's a bit faster than that, actually. But it's a modest interest rate yield curve would calibrate in about 10 milliseconds using a C++ library. That would be considered a slow curve in electronic markets, or a modest curve perhaps. And what we would do is, in between that full rebuild, we can update the original curve using this method, using the Jacobian method, for a super fast refresh in real time in between the slow curve build. Now, if your yield curve sort of takes 1 minute to run, or 30 seconds, say, then you can just incrementally sort of refresh that the original curve using the Jacobian method, and just keep updating it that way in between the full rebuild calculations. So that way you have a combination of sort of two curves. You always run your slow curve, and in between refreshes, you can use the Jacobian method. Now, what some people do is they hold this Jacobian constant for the majority of the day, and if there's no excuse me, if there's no sort of sharp movements in the market, they'll just use the fast curve all the time, and maybe only update the slow curve, or do a full rebuild every hour or every half an hour. But if you do have the full curve available at a faster rate, why not use it, right? But I've seen some shops where they'll build the full curve maybe every 30 minutes, and then just refresh um, curves, the curves sort of in real time using this fast curve Jacobian update throughout the day. So you take your original curve, you multiply the inverse Jacobian by the market data, and you add those two things together, you get your new curve. So that's how you would uh, take sort of a slow curve and sort of refresh it in real time. Now for risk calculations, the Jacobian can be used here too. So the requirements are, you need a curve Jacobian, which we've discussed, and a trade portfolio Jacobian, which we're going to discuss shortly in our case study. And you multiply these two things together, and you'll get your risk. So in this example, for interest rate risk, we're looking at the DV01, and this is the risk of what's the risk of 1 basis point movements in forward rates and discount factors combined. So the trade Jacobian captures the change in PV for a change in forward rates, and the curve Jacobian captures the change in forward rates to a change in par rates, which is the price. You can see here the two LIBORs are going to cancel out, and you're left with then the change in PV for a change in par rate. And this is why we have to select the curve Jacobian to have par rate here, because if you had PV, if you had change in forwards for a change in PV, you would be left with DPV, which is just one. And then you have no risk. You just have 1 basis point of risk, which is just incorrect. So you must use the par rate if you want to for your curve Jacobian state variable. So in terms of how this calculation works, so we compute this trade Jacobian, which is typically a vector, and this is what we see down here. We've multiplied it by 1 basis point already. And then this is the inverse curve Jacobian. You can see two lower diagonal matrices, so kind of glued together. And you multiply the two together, and you get your risk. And you can see this is a 3-year interest rate swap, and all the risk is in the 3-year bucket. So I guess this is 1 million notional as well. I can tell from numbers. So it's giving you the interest rate risk, and all your risk is falling in the 3-year IRS bucket. Why is that? Because it's a 3-year par swap. So all the risk is falling in the 3-year bucket. Now, risk is, so then using this approach, risk is a matrix operation. It can be parallelized. It can be vectorized. It's already fast if you do nothing, but you can even speed it up even further, so you can calculate it in nanoseconds. Matrix dimensions must agree between the trade vector and the curve Jacobian. We'll discuss that shortly. And the way that we format the trade Jacobian to have the right dimensions is by using barycentric weights coming from barycentric interpolation. Barycentric weights from barycentric interpolation, what does that mean? It means we use regular interpolation, but instead of returning the interpolation value, we return the interpolation weights. And those weights then tell you how to map and what weights to use for every cash flow to map them to the right risk buckets. So you take all the cash flows of your the risk cash flows of your trade Jacobian, and you map them into the risk buckets of your curve Jacobian using the weights that come from your barycentric interpolation. We'll talk more about that later. Now, so that's the example. You multiply the trade risk factor by the trade Jacobian by the curve Jacobian, Trade Jacobian is typically a vector. Curve Jacobian is a matrix. Multiply the two together, you get back a vector, which gives you all the real-time risk and gives you the risk in the right buckets as well, so that you know how to hedge your risk. In this case, I have to hedge using 3-year interest rate swaps. Right. Now, pricing and practice. So at this point, I'm going to take you through a case study and you'll see a lot more detail. It will show you how to calculate real-time credit models and we'll show you how to calculate real-time credit portfolio risk. That's really powerful. And I'm going to dig a lot deeper here now and give you some live examples. Right. So here, firstly, this is a credit market, and so we're going to calibrate our models using credit default swaps. Now, credit default swap, what is that? Very briefly, this is the CDSW page in Bloomberg, where I'm pricing a credit default swap for 5 years on the US government. Credit default swap is an insurance product that protects against credit default risk in exchange for regular premium payments. So it's a risk transfer from the buyer to the seller of protection, and CDS instruments quote in the market as a par spread. So you can see it sort of here is 41.34 is the par spread. That's the spread that the premium that you have to pay in basis points, such that the premium payments offset the protection that you're going to get, exactly making the trade worth have a zero PV. So which is what we sort of say here. So CDS instruments quote in the market as a par spread S, 41.34 basis points. That makes the trade priced to zero. Now this trade's priced at 25 basis points. It's not the 41, and therefore there's some PV. But if you were to change this trade spread here to this coupon here to 41.34, instead of having a cash amount, you'll have zero value. Now the formula for pricing a CDS is here. We have a premium leg. So in this case, we're selling protection, so we're receiving the premium and we're paying the protection. N into 1 minus R is the loss given default. All the terminology is here. So N is the notional, 1 minus R is the recovery, 1 minus R is the loss. So notional times the loss, that's the loss given default. Q is the probability of survival. Q minus Q, that's the default probability of default between these two times. P is a discount factor. Now the premium leg is notional times the spread times the year fraction times the probability of surviving and times the discount factor P. So there's the formula there. I do outline it a lot more in the documentation that I have in the links. So this is quite a quick overview. So this is the formula. And if you want to compute the par spread, if we have a par spread S, that's the spread that's going to make the trade price to zero. So if we set the PV to zero, rearrange for S, you get this formula. And we can use this formula in the calibration process. So this is the formula to compute the par spread. And that's the par spread is equivalent to the price. And that's how a lot of CDS will quote in the market as a par spread. And therefore, that's why I have to show you this formula. Right, on to the next slide. So when we want to build a credit curve is a curve to price. So basically, a credit curve is a time series of a term structure of hazard rates, lambda. Now, to price CDS contracts, we need survival probabilities Q. So we need to be able to price CDS. We know discount factors from our interest rate models. So before you can price a CDS, firstly, you need an interest rate curve. Secondly, you need to know the probability of surviving. And then once you have that, you can price your CDS. You have everything you need. Now, the probability of surviving, we calculate that from our credit curve. And the credit curve is a curve, it's basically a curve of hazard rates lambda. Now, lambda is the instantaneous probability of default at any given point in time. So, and then given the hazard rate, we compute the probability of survival as follows. So this probability of survival Q, it has this formula, which is just the sum of lambdas times the time. Now, credit curves are typically assumed to have piecewise constant interpolation, also known as flat or left continuous interpolation. So we have data points here at the end of each sort of what's looking like a bit like a histogram. At the end of each sort of period, we have a hazard rate, and it's flat or constant up to that hazard rate, and then it moves to the next hazard rate, and so on. And that's called left continuous or flat. So here we've got quite a lot of instruments, so which is a little bit uncommon for a hazard curve. The reason why we assume piecewise constant is because it's not. Sometimes there's only one data point. It's just not enough market data typically to do anything else that's meaningful. But in this case, we have a lot of data points. That's because this is taken from a US Treasury curve where there's lots of data typically, more data than you normally see. So they're typically flat, piecewise constant, piecewise flat looking curves like in this diagram here. So this is how hazard rates, what a hazard rate curve would look like over time. So that's the credit curve. Now, once you know these hazard rates over time, if you want to then sort of refresh the hazard curve in real time, perhaps your credit model isn't as fast as you like it to be. You want to accelerate it. What can you do? You build your hazard curve once, and you know your original hazard rates here, lambda, and then the inverse Jacobian will tell you how do your hazard rates change as market data par spreads change. So we have our inverse Jacobian, which is this diagonal looking matrix. We multiply it by the market data. That will then tell you how the hazard curve has changed, and you add it onto your original curve, and that will give you your new hazard rates. That operation, this multiplication process, matrix multiplication process, it's super fast, and this can be parallelized and vectorized. It can be made even faster to calculate in nanoseconds or more. And again, the implementation would be you would do a full calibration of your hazard curve, just like what we did for the interest rate curve, for the yield curve. That would sort of tick away in the background. Quite often, that would sort of calibrate within 10 milliseconds. If you have a slower implementation, it's fine. And then in between the slow curve or the full calibration, whilst the full calibration is running, you could refresh your original that existing the latest sort of full calibration curve using the Jacobian method, and that would refresh and update in real time. And so here's an example of that. If you do have a slower model, then this is perfect because you can have real time refreshes sort of whilst you're waiting for full calibration in the background, and that would be very accurate. With no loss of generality, so that's awesome. So this is how we would calculate a real-time credit, calibrated real-time credit model to produce these hazard rates, which you need to calculate your survival probabilities for CDS pricing. Now, let's talk a little bit about credit calibration and risk. So credit curve calibration, we would take liquid CDS instrument prices and using the CDS par spread formula that we just looked at, we can solve for the hazard rates. So we take CDS instruments that are quoting in the market. We don't want stale prices. We take liquid instrument prices in the market. We see the we given that, and then we have the par spreads, and then using that par spread formula, we can solve for the hazard rates. Credit markets typically assume hazard curves are piecewise constant or flat. Now, this means because of that, it means we could choose to bootstrap our hazard curves and solve for one lambda hazard rate at a time, or we could use a solver algorithm, which is preferred to determine the hazard rate curve all in one go. So we'd solve for all lambdas at the same time. Now, we prefer to use the solver algorithm because we get this Jacobian as a byproduct, and that Jacobian is a very powerful piece of data, a piece of information, which allows us to do the fast curve rebuilds, allows us to do real-time portfolio risk calculation. So we always want to use the solver algorithm rather than the bootstrap because we get a lot of extra information. Now, the credit curve Jacobian, which is computed, for example, through the Newton-Raphson approach as a byproduct, and can be used for credit risk CSO1. So using a gradient descent solver will produce a credit curve Jacobian by default. You just have to choose to store it. So don't just store the hazard rates, also store that curve Jacobian J, and specifically compute the inverse of that Jacobian and store that. We're less interested in the Jacobian itself. We want the inverse. So store the inverse Jacobian. Then this inverse Jacobian can be used for real-time curve updates and real-time risk calculations. We must solve for the CDS par spreads, not the PV, for risk calculations. And so if you look at the credit spreader one or CRO1, The trade Jacobian, which you're going to look at next, will give us the change in PV for a change in hazard rate, lambda. We multiply that by the curve Jacobian, which is d lambda ds. This is an inverse Jacobian, and that's the change in hazard rates for changing path spreads. And what you see is these two lambdas are going to cancel out, and that will leave you with the change in PV for a change in path spread, and you multiply that by 1 basis point. And you can sort of see here why it can't be, we can't have a curve Jacobian with dPV, d lambda dPV, because everything cancels. You'll have the lambdas cancelling out, the PV cancel out too, and then you don't have any risk. So that's why I'm saying we must pick the risk factor. You must pick, in this case, don't use PVs, use the path spreads instead, because that's what you're observing in the market anyway, not PVs. So do use when you're solving for the curve Jacobian, when you're picking your target function, pick a target function such that you can generate your real-time risk. So for interest rates, you want to solve for par rates and as your target function, and also in credit markets, you want to solve for par spreads. Now, the trade Jacobian, that this missing component, right? This trade, which is typically a vector, how do we calculate it? So basically, what you're doing is for your CDS, you differentiate each cash flow with respect to the hazard rate lambda. This generates a trade Jacobian or a risk vector. So here we have the PV formula for the CDS, which we quoted earlier, and we differentiate each cash flow for the premium and protection leg by lambda. Now, there's no lambda in here directly because it's inside the survival probability function, which is Q. I've written that out for you here. And so if we differentiate this with respect to lambda, which is what we're doing here, it comes out as something very straightforward. It's minus t times, so minus time times the probability of survival. You just substitute that back in. And basically all you get is exactly the same formula, but each of the components are multiplied by minus time. So the change in PV for change in lambda is minus time as each premium coupon. And for the protection leg, because there's two Qs, it's the minus the change in time. And so you just sum up all those calculations for each of the different coupons. And then you have to allocate the coupons to the correct risk buckets, because the trade Jacobian dimensions must match the buckets of the curve Jacobian, which we'll talk about shortly. So how do we make things work? It is quite tricky to put all the components together, and here's some of the secret sauce. So the trade Jacobian, or the trade risk vector buckets and dimensions, must agree with the curve Jacobian. So CSO1 is you'd have a trade risk vector with dimensions 1 times n, where n is the number of calibration instruments. You multiply that by the curve risk matrix, which is n by n, times by the ship size. Now we can use barycentric interpolation, in this case left continuous, to fit the trade risk to the curve risk buckets. So we must use the same interpolation method, left continuous, as we used for the credit model calibration. And then we use barycentric interpolation to place each of the, so we use this formula here, dPV d lambda for the CDS. And so for each term in this summation, in these summations, we use barycentric interpolation to place those risk components into the buckets, into the buckets the risk matrix buckets. So, for example, if we have a risk matrix with yearly buckets from 1 to 10 years, we would have to put all our coupons in buckets of 1 year, of 1 to 10 years as well. And we would place those coupons into the correct buckets using barycentric interpolation. So we would scale our coupons, we would multiply coupons by these interpolation weights. So barycentric interpolation is the regular interpolation. Regular interpolation would give you a value. Barycentric interpolation gives you the weights to use for your values. And those are the weights, the distribution weights, to format your risk factor into and place your risk coupons into the correct risk buckets. So that can be done as part of pricing. So after performing barycentric interpolation on the trade risk vector, and what you're doing is you're formatting your trade risk trade risk factor to fit and match your risk matrix. Now, and you're normalizing it, you're standardizing, you're formatting your trade Jacobian, and that means that all trade Jacobians are in the same format, and that also means you can net them together to create portfolio Jacobians. So if you have, say, a book of 1,000 CDSs, you could net all of your trade risks together into one single risk factor, and which would be your portfolio Jacobian. Instead of a trade Jacobian, you would have a portfolio or a trade Jacobian. Now, these trade Jacobians, they only need to be updated once a day. So the portfolio Jacobian, so all these trade Jacobians could be computed once a day at the start of the day, or if you prefer at the end of the previous day. You sum them all up, store it all down, and then just reuse it throughout the day. So these trade Jacobians, the portfolio Jacobian only needs to be computed once a day. So once we do that, then we have our trade Jacobian. We multiply it by the curve Jacobian, which is ticking with the market data, and then you would get your real-time risk. So there's some secret sauce here, some things that we need to sort of consider, and there are some tools that we need to use just to format the trade risk factor and to make everything work. Now, without this information, it's quite difficult. So this is quite important information and it's good to have. Now, let's have a look at the output of everything. So real-time bucketed credit risk requirements. We need a curve Jacobian, and we need a trade or portfolio risk factor. So for CSO1, we take the trade Jacobian, and then we multiply by the curve Jacobian, and then times 1 basis point. Now, what some people do, which is quite commonly done as well, you can see the trade risk factor. These quite large numbers. This is a 1 million notional 5-year CDS, and this is the trade risk factor. This looks a lot better if you scale. You could scale the trade Jacobian by this 1 basis point straight away, and then instead of having 3 multiplications to do, just have 2. So sometimes this looks better if you include the 1 basis point in trade risk factor, but you don't have to. So anyway, so we talked a bit about how to get the trade Jacobian, which is and how to format it using barycentric interpolation. We multiply that by the curve Jacobian times 1 basis point, and then you get your risk. So here's the trade risk factor. You multiply this by the curve inverse curve Jacobian, multiply that by the shift size or risk scenario. If you want to run a risk scenario, you could do that as well. You could say, what if hazard rates change by an amount larger than the 1 basis point standard? Now, for a 5-year CDS, when you do all of that, you can see you get this factor back, which is your bucketed risk, and you can see your 5-year CDS, all of the risk is falling into the 5-year bucket because we calibrated to a 5-year CDS. So all of the risk is in that bucket, which means you could hedge a 5-year CDS, surprise, surprise, with a 5-year CDS. Now, trade risk factors, as we said, can be netted to create a portfolio risk factor, and risk can be parallelized and over vectorized, which means this calculation is already very fast, could be made even faster. Vector and risk matrix dimensions must agree, you mentioned, using barycentric interpolation for the weights to how to allocate your risk cash flows to the right buckets. We can configure trade risk into the right curve buckets so that we can perform this calculation. But like I said, the trade risk factor, you only need to calculate that once a day. So once you do that, it's a simple multiplication, and that's very, very fast. It will give you real-time bucketed credit risk for an individual trade or for your portfolio. Now, credit risk notes. We're about to some important points. Choice of calibration instruments. The instruments you choose to calibrate to are also going to be your risk bucket. So we pick liquid instruments to calibrate to. These liquid instruments will be our hedging instruments. That kind of makes sense. Now, however, if you want to change those risk buckets and use different calibration instruments, we can modify the risk buckets using the implicit function theorem, and we can refer to these notes here by Schellenkrieg on how to do that. It's also covered in my book. And we also mentioned, because we normalized and formatted our trade Jacobians, it means that all trade Jacobians are in the same format, and we can net them together to make portfolio Jacobians instead of trade Jacobians. Trade Jacobians, as we mentioned, only require daily updating, so the portfolio Jacobian can be computed once at the start of the day or just once at the end of the day for the next day, whichever you prefer. But the key being you only need to compute it once a day. Now here, just to finish off, I'll show you some examples. Here's a 5-year CDS. Yes, 1 million notional 5-year CDS with a premium of 2%, 0.2%. We calculate the CSO1 from the trade Jacobian times the curve Jacobian. Here's the trade Jacobian. Here's the inverse curve Jacobian, which is this diagonal matrix, and this is the result you get back. So all the risk in the 5-year bucket because it's a 5-year CDS, and we calibrate it to a 5-year CDS. So we can hedge this 5-year CDS with a 5-year CDS. Now, when I calculate it analytically, I get 456 as the CSO1. And when I do the same calculation numerically, I get exactly the same number, which is very good. And numerical risk that just means what if I modify the market data directly and reprice many times? So I bump each of the buckets one by 1 basis point, reprice many times. That's numerical risk. It's bumping approach. I get exactly the same numbers from this Jacobian approach as I would do from numerical risk. The difference being that the analytical risk is real time, numerical risk is exceptionally slow, and you'd have to reprice every instrument in your portfolio many times. So that's, excuse me, that's a brute force approach that we typically don't want to do. The analytical risk is going to be real time in your portfolio. It's completely awesome. That's the way to go. So this is the first example. The second example, I use a 3-year CDS instrument here. So you can see my trade risk factor is here. My inverse curve Jacobian is here. Multiplied together, these are my risk results. Now you can sort of see I've got 284 risk analytically. When I perform the same calculation numerically, I get exactly the same number. So that's great to hear. But now you see I don't have a 3-year risk bucket. So what's happened here? It's split my risk now to hedge this 3-year CDS. I have to use part of a 5-year CDS and part of a 2-year CDS. And what's happened sort of here in terms of the risk numbers, in terms of explaining this number, you can sort of see I'm 3 years closer to the 2 than it is to the 5. So I've got 2/3 of the 2-year risk and 1/3 of the 5-year risk. If you look at 1/3 of this, it will be that number there, 158. And that's a bit like barycentric interpolation on the risk. That's how that would work. So the weights here, the weight is you take this 284 number and you're taking the 2-year risk, the 5-year risk, and you're assigning sort of 2/3 of your risk to the 2-year bucket and 1/3 to the 5-year. So what I mean is if you were a 2-year, 2/3 of a standard 2-year CDS and 1/3 of a 5-year CDS. So if you think of that in cash terms for $1 million, that would be 666,000 of short of the 2-year CDS and 333,000 short of the 5-year CDS because we had a $1 million notional here. So it's 2/3 of 1 million in the 2-year and 1/3 of 1 million in the 5-year. And that's why your risk is split in that way. And the reason why it's split is obviously you don't have a 3-year bucket to hedge with, you only have a 5 and a 2. So therefore it has to split the risk between 2 buckets. Now, all the information, everything, all the materials we presented here are well covered in my book. Here's the link. If you have any further questions or you want further information, please follow me on LinkedIn. If you enjoyed the slides and this has been useful to you, please subscribe to my YouTube channel. Hope you've learned a lot. Hope you had a lot of fun, and I'll see you again soon. Thank you very much for your time.